Do is start with a little acknowledgement. This is my technical acknowledgement to Hyman Minsky. Who's heard of the name Minsky? Virtually everybody. I've asked that question before 2005. Almost no hands would have gone up in a business meeting like this, 2 or 3 maybe. So it's a dramatic change. And I love my favourite phrase by Minsky is stability is destabilising, which is completely outside the mindset of conventional economics, and that's the logo for the software package that I've built in his name called Minsky, which you'll see a couple of examples about later. What I have to acknowledge here is, of course, I'm accused of getting it wrong in Australia. I called a crisis, it didn't happen. Why should you trust what I've got to say? Well, look back at my argument in 2006, and again on the debt deflation blog. There's a whole set of what Paul Keating would have called a beautiful set of numbers that came out in mid-2006. And I said, look, the economy is nowhere near as good as these figures implied is. And I had to explain why I had this sort of Cassandra position. And the basic argument was you can't continue going on with an unsustainable trend in debt. Talking about private debt. And you couldn't pick when it might turn around because whether the debt continued rising and therefore the demand rose depended upon individual decisions to borrow as well as the overall macroeconomy. But at some point the ratio of debt to GDP had to stabilise, and when that happened you're likely to have a recession. And now that argument didn't work in Australia for a simple reason, because if you take a look at the data, I'm certain, by the way, that Australia and South Korea did not record a recession. I think Canada did not, or it may have been a mild recession. But those are the only 3 countries in the OECD to have anything other than a serious downturn in 2008. If you look at what made me think there's going to be a crisis, not just in Australia but globally, it was this chart. And the chart I'm going to show you, I was preparing as an expert witness in a court case over predatory lending, where a solicitor had arranged 7 consecutive loans for the same ex-employee of Toll, which had defaulted on all 7 loans. And by the final loan, a debt I think of $150,000 had become a debt of $330,000 in about an 18-month period. So I dived in to do this case, and as part of it, I was arguing the macroeconomic impact of this allowing this sort of lending was damaging for people outside the particular contract, which is why you could get the contract overturned as we did in the court case. But I wrote the line. I wrote it, by the way, at 3 o'clock in the morning, actually at 11 o'clock at night in Perth, because I'd miscalculated how many days I thought I had 1.5 weeks. I had 4 days to get this thing done. And I wrote the throwaway line of saying debt to GDP ratios have been rising exponentially. I knew as an ex-lawyer, as an expert in a case, you can't rely upon hyperbole. That's the barrister's job. So I had to look it up, and I thought I'll find the data, and it won't quite be exponential, but it will be rising. So I had to write a few mathematical routines to import the data and graph quarterly against monthly data as you have to do to get a debt to GDP ratio. And at about 3 o'clock in the morning, I'd got the code written, imported the data. And the bottom line I'm going to show you here is what I saw straight away, the black one. And I said, holy hell. One look at that and my jaw just hit the floor. That's got to be so close to exponential it's not funny. So I did a regression on a basic exponential there, the correlation coefficient with a simple exponential for the rate, not the level of debt, which would be fair enough, that can rise exponentially, the ratio of debt to GDP. Correlation with a simple exponential function was 0.9912. I thought, well, obviously we're in for a hell of a crunch. We haven't had a debt level like this since 1976, which is where as far back as the RBA data went at the time. So I rapidly went to the Federal Reserve and downloaded its data, what's going to happen globally, and that's what I saw for America. And that's going from data from 1952 through to 2000 and very into 2005. And I thought, this is going to be the biggest debt crisis since the Great Depression. Somebody has to warn about it. At least in Australia, I'm that somebody, which is why I went on the media warpath from the end of December 2005. Now, why didn't we have a crisis? Well, if you take a look at what happened to that trend I showed you. I'm now going to show you data from the Bank of International Settlements, because just recently, about 2 years ago, 1.5 years ago, the Bank of International Settlements began publishing a standardised database of private and public debt levels broken down into household, corporate debt, non-financial sector debt. There's no financial sector debt, unfortunately, recorded because it's just too low quality. You can't know who's lending to whom at the financial sector level. But that database now lets you look across all countries, and there's 41 countries in the database right now. So same 2 countries are now looking at what happened to those trends. And you can see that The orange line is the trend, exponential trend for Australia. We are back on and above that trend. Whereas the blue line is the exponential trend for America, and it clearly broke in 2006. If you take a look at it back in 2000, coincidentally, on this database, Australia and America had the same private debt to GDP ratio at that time. Now, since then, America's well and truly broken away from the trend, and it's when you now look at the level of debt that is in Australia versus the level of private debt in America, we are now 60% higher than America. So a major reason for our apparent outperformance since the great global financial crisis is we've spent 0.6 of a year's worth of GDP more than the Americans have spent. Okay? That's a huge reason why we've looked like we've done really, really well. But we've basically borrowed our way into prosperity, and you cannot keep doing it. So we've approached our way, we've just delayed our day of reckoning and increased the amount of debt we're going to have to deal with in the process as well. We're not alone in doing that, unfortunately. Now, to argue that private debt plays a role would have Paul Krugman saying what a load of rubbish I'm speaking right now. Anybody see the debate I had so-called with Paul Krugman about 4 years ago? Okay. According to the mainstream, this is what Krugman says in his book, End This Depression Now, exclamation mark. When debt is rising, it's not the economy as a whole borrowing more money. So he's arguing there's no relationship between the level of debt in the economy, private debt, and the amount of money supplied. They're independent from his point of view. And that is nonsense from a technical point of view. It's a childish economic theory game, a childish model that economists have. And for about 40 years there's been a non-orthodox group of economists saying that's not the truth about lending. Banks create money by lending. Loans create deposits, not the other way around. And it's been a minority position, but the Bank of England finally came out just 2 years ago and said that we're right, the minority is correct, the majority is quite wrong. When you look at the technical side of how banks operate, when a bank creates a loan, it creates deposits. Bank lendings create deposits, not the other way around. So the idea that banks just are intermediaries is wrong. They are loan originators, and that makes an enormous difference to the impact of credit on the economy. But I need to explain why that has an impact, because even in my own non-orthodox circle, a lot of people think because expenditure is identical to income, there's therefore no role for credit. I want to show you why that's wrong and why there's a very definite role for credit in total demand. So I'm going to make it work a bit here after your lunch. What I've done here is imagine dividing an economy into three arbitrary sectors, goods and services, financial products, whatever you like. Just it doesn't really matter what they are. And say, imagine spending by each sector on the other sectors where you can't borrow money. So what I've got is a flow of A dollars per year being spent by Sector 1 on Sector 2, and a flow of B dollars per year being spent by Sector 2 on Sector 3, and therefore that row adds to zero, as each of the rows does. So the negative is showing the expenditure, and the positives are showing you the income. Now, if you add up the horizontal, the diagonal there, and take the negative, what you've got is aggregate expenditure in the economy, and it's necessarily equal to aggregate income. Now, on that basis alone, that's what a mainstream economist will use to say, therefore the level of debt doesn't matter. Now, what you get is it's an absolute identity between expenditure and income in that model. Now let's pretend that the mainstream knows what it's talking about, which it doesn't, but imagine that banks simply facilitate loans, they don't actually originate loans. So what I now show is that lending is Sector 2 lends to Sector 1 in this little example, and what I've got happening is there's a flow of as well as the A plus B as beforehand, Sector 1 is borrowing a flow of L dollars per year from Sector 2. So part of Sector 2's expenditure, effectively the financial flows, is a flow to Sector 1. And then Sector 1 spends that money on Sector 3, and of course because there's a flow of loans, there's also a stock of outstanding loans, so Sector 1 has to pay interest to Sector 2. That's why Sector 2 is doing the lending in this model. Now again, you add that neg diagonal up, you get exactly the same answer if you add up the off-diagonal elements, and in this case what you find is the interest on debt becomes part of the aggregate expenditure and aggregate income. So gross financial transactions are part of demand, even in this model, which itself is wrong. And I don't think the mainstream realises this, that even in their own model, a false model, credit still has a peripheral role because it's the gross financial transactions become part of aggregate income and aggregate expenditure. So there is a role, even in their false model of the economy. Well, let's try the realism where banks originate loans. In that situation, what I've now got is the stock of loans I can now show as an asset of the banking sector. The flow of loans per year is L dollars per year here. Expenditure by Sector 1 is now exactly the same. It's spending the money it's borrowing on Sector 3, but it's paying interest now to the banking sector, not to one of the other non-banking sectors, and therefore the banking sector has an income, so it's also spending as well. You put that together, and notice there's only L, which is the flow of loans in dollars per year, which is credit, now appears only once. There's no offsetting negative for it. And the same thing applies on the income side. So when you look at aggregate income, again it remains identical to aggregate expenditure, but it now includes credit. And that's left out of mainstream thinking. Now if you're leaving out credit, you're leaving out one of the biggest and certainly the most volatile element of demand in an economy. And therefore what they call black swans are very white swans, or at least they're black swans in Australia. We know they exist. So credit is part of gross expenditure and gross income, but also gross realised capital gains. In other words, a huge part of the engine that drives the financial sector. So if you have an economy with rising debt, you'll have more demand than an economy with falling debt. You can't ignore the level of debt as part of demand in the economy. And it comes in two senses. You can say there's demand from the turnover of existing money, which is the A to I that I've got in that equation there, plus credit, which is created by new debt in the banking system we have. Now, how do you measure it? Well, that's impossible to measure accurately for the simple reason that we don't measure the turnover of existing money. When people go shopping, we don't actually, at the statistical level, record whether they spent out of their wallet or their savings account or whether they spent on their credit card. But we do measure the change in debt very accurately. And we know that roughly 85% of new debt is financing asset purchases now. It's not financing goods and services. So you can, with that rough guide of where money is spent, and this is from Positive Money in England, and they claim 31% of money created goes to the financial sector and 51% to property, with only 8% going to either businesses or consumer loans. So you can therefore say roughly 85% of the money which is being created is not being recorded in GDP, whereas the other 15% is being recorded in GDP. Pardon me, I've clicked on a link there, which it won't find. Okay, let's take a look. So total demand, and therefore income plus realised capital gains, spelling it out in detail, is the turnover of existing money plus credit plus gross financial transactions. Now the mainstream is ignoring credit and gross financial transactions in measuring how much economic activity is taking place, which is why they're totally wrong about the state of the economy at any point in time. So how do you try to measure it or get a rough idea? Well, GDP is a poor measure of the velocity of the turnover of existing money because it includes, of course, partly purchases of goods and services paid for by credit. But it's mainly the turnover of existing money. On the other hand, the change in debt is a very accurate measure of total change in the total level of credit, because we do record that independently. So it's dimensionally accurate to add the two together. They're both flows in dollars per year. And empirically it's roughly okay to do that, to get an idea of just how much debt is being created. An analogy of what I'm doing to add them together, consider you've got a river where there's a pump which can pump water in or out of the river at that point. Then the total flow in that river is going to be the flow in megalitres per year of the river itself, plus or minus what's being injected in or taken out by the pump. And this is the one reason I'm glad to be back in Sydney again. You don't see weather like this now, do you? This is the floods in northern England earlier this year. But that's, in effect, the flow of the river is like the turnover of existing money. The impact, the injection in or subtraction from demand from new debt is like the pump itself. So you can add GDP to change in debt to get some not precise idea of when financial crises occur, but certainly why they occur and why we have a slump after one, given the level of private debt we now have. So I want to give you, this is another bit of intellectual work before I start showing you some data. Imagine a country where there's a given initial level of private debt to GDP. I'm going to start with 50%. And then that debt is growing at 20% per annum in nominal terms, and mainly used for asset purchases. Therefore I can do this addition of the two, GDP plus credit. And nominal GDP is growing at 10%. That's roughly, both those figures are within the ballpark of what China's reporting as its current growth levels of both debt and GDP. And then in the final year, the rate of growth of debt doesn't stop, but it slows down to being just the same as GDP, so the debt ratio stabilises. What happens to demand in that situation? Well, if you start from 50% of GDP, then in 5 years' time you'll reach 77%. To take you through the table, just for hypothetical reason, we're starting with a GDP of $1 trillion, which becomes 1.1 trillion, 1.21, growing by 10% every year all the way through. In the next row, what I've got is debt. If the debt ratio is 50%, then the initial level of debt is 500 billion. It rises by 20% at 600 billion the year after, so the debt ratio rises from 50 to 55%. Total demand in the economy is this GDP, 1.1 trillion, plus the 100 billion of new debt, which is credit, so total demand is 1.2 trillion. And then you keep on going out here until you get to the final year, and that year the debt ratio stabilises, so the level of debt still grows, because you're trying to keep that ratio with GDP constant, but your demand goes from 1.6 plus 207, which is 1.8 trillion, to 1.7 plus a much, much smaller level of credit, 124. So you get an increase in demand, but the increase in demand, the change in demand each year goes from being 11% to 4%, which is a substantial slowdown, but it's not a crisis. And you've still got positive growth in total demand and total incomes and capital gains. If you go to a level of 100% of GDP as your starting point, then you reach 155% after 5 years. But what you have in that same basic idea is in the second last year, your GDP is 1.6 trillion, your change in debt is 400 billion, the total is just over 2 trillion. The year after, GDP has gone up by 10%, but the change in debt is much smaller because it's stabilised. It's gone from 10% increase to a 20% increase to a 10% increase. It's gone from 415 billion of credit to 250 billion of credit, and the aggregate level of demand is actually lower than the year before. So even at that level, you get a slowdown in demand. That would be recorded as a recession. Now let's look at the actual levels of debt we're looking at these days in places like Australia and China. What happens if you have a starting point of 125% of GDP as your debt level, and that rises at the same rate? Well, you reach 193%, which, by the way, is about 15% lower than Australia's current private debt level. What you get in the final year is the GDP is still at 1.6 trillion. The change in debt virtually half a billion. Total demand 2.12. The year after, 10% higher GDP, much smaller credit growth, and you actually have a negative. The aggregate is less than it was the year before, and you have a recession. That's what I was expecting to have happen to Australia back in 2007, 2008, but the Rudd government's policies stimulated private borrowing once more, what I call the first-home vendors boost. Got the household sector back into borrowing again, and then of course you had all the borrowing coming after that from the business sector for the minerals boom, and now we're getting to the end of both of those, of course. So a debt crisis is inevitable for countries which have a high private debt to GDP ratio, because to sustain the growth rate they've got requires debt to grow faster than GDP forever. It simply can't do that. And we are now, in Australia's case, we now have the highest level of household debt to GDP in the world. And that's out of the 41 countries that have data from the BIS. So a crisis will occur even if GDP continues to grow, which of course it won't. And this is why all the countries you saw having the global financial crisis did so, none of which you'll see none of this argument with the mainstream, by the way. They still are simply ignoring the role of debt even 10 years after the crisis occurred. So let's look at Japan, which was that should have been the canary in the capitalist coal mine to tell us something was fundamentally wrong. If we'd learned from Japan, I wouldn't be having this conversation with you. Now, the line that everybody focuses upon here is the orange line, which is the ratio of government debt to GDP. And you can see that was quite low, about 60%, and trending down before the financial crisis hit, and then it's been trending up ever since, and that's what all the commentary in the media and in mainstream economics is about. What really caused the crisis was this huge explosion in private debt, particularly the last 10 years, which the Japanese themselves referred to as the bubble economy period. Then that level stabilising and now falling. That stagnant and high level of private debt is why Japan has been in the funk for 1/4 of a century. And it's something we simply can't afford to repeat in the far less homogenous societies we have than Japan has. So when you now look at the change in debt, can I identify when the crisis began? The red line is change in private debt. The crisis began in 1990. And when you correlate credit with unemployment, again, according to the mainstream, there should be no correlation. That's Ben Bernanke. You can look at page 24 of his essays on the Great Depression. There should be no significant relationship between debt and macroeconomic variables. That's correlation there over 40-something years of data is minus 0.88. That's I think that's significantly different from zero. Any disagreement? They continue ignoring this stuff. I mean, I've been publishing data like this for 10 years, and I still don't see any of them do any empirical research on it. Now, when you then look at the asset markets, of course, there was a huge bubble in household debt going from 3% of GDP to 9% of GDP, and then you can see the plunge that occurred there. Up goes the house price index until shortly after the peak of the private debt borrowing, and then it's fallen 70%, and then it's flatlined ever since for about the last 6 or 7 years, flatlining with that huge fall in house prices. Now, what drives, and this is a slightly complicated argument, what drives house prices is the acceleration of mortgage debt. And I'm now going to define mortgage debt. The change in mortgage debt is mortgage credit. So when you think about the monetary demand for housing, it's fundamentally mortgage credit. You divide that by the price level, you've got a rough index of how many physical houses can be bought. You take the physical supply on the other side, you do a simple analysis of a price equilibrating between the two, and you find there's a relationship between the change in mortgage credit and the change in house prices. This is the Japanese data. That correlation over, what we got there, 55 years is 0.5. Now again, this is supposed to be zero according to the mainstream. And the economy, I call this little graph my smoking gun of credit, because what I do here is take GDP as the red line, add change in debt to it, which I know is empirically slightly wrong, but it's a reasonably accurate guide at the same time, with so much debt being created for asset purchases these days rather than goods and services. And the Japanese economy tanked when the credit level started to fall. Credit I'm graphing on the right-hand side here. This level of credit, which is change in private debt per year, is 27% of GDP. That was the peak level. It then plunged down to minus 15% in 2000, and for most of that period it's been negative. When you add the two together, GDP plus credit, you see that they haven't had the same level of nominal demand in Japan ever since the crisis. Now, before the crisis, the average level of credit for that decade, 1980 to 1990, was 15% of GDP. The average since then has been minus 0.5% of GDP. So what we're facing in Japan's case and also in America is not secular stagnation. That's a piece of jargon that Larry Summers has dragged out of the past and tried to explain what they can't explain. It's credit stagnation. Credit demand is a normal part of a well-functioning capitalist economy, but it's evaporated in all the countries that had these debt bubbles. We're one of the last ones to still be having credit demand, which is about to run out. So look at the United States now, using the same scale on the left-hand side. So America didn't reach the same peak level of private debt as Japan did, but same story. Government debt was falling with a couple of blips, courtesy of invading other parts of the world and bombing the hell out of them. But the rise in government debt began after the crisis hit. The crisis was caused by this level of debt peaking and then falling. Now looking at the change in debt, which again is credit, and graphing that against the unemployment rate, the correlation of credit to the unemployment level in America over 40 years, pretty much, 35 years, is minus 0.64, and you take the years from 1990, it's minus 0.93. So credit is the fundamentally dominant driver of economic activity in America. And again, looking at that house price story, you have a dramatic increase in house credit, mortgage credit, going from 3% of GDP at the bottom of the end of the 1990s recession up to about 10% of GDP, then plunging, then starting to rise again, and house prices have recovered a bit because they have risen. Look at that relationship of the change in mortgage credit to the change in house prices, and using Granger causality, which is a very inappropriate way to measure this causality. It's more likely to reject causality where it actually occurs, because like most econometric tests, the Granger causality is completely linear in its logic. This is a highly non-linear relationship. But the correlation between change in house prices in America and change in mortgage credit is 0.6 since 1976. It's higher again, of course, since 1990, after the bubble really took off. So what's driving house prices is accelerating mortgage debt everywhere else in the world except Australia, because we're different, aren't we? Well, we'll see that in a moment. Here's the smoking gun of credit for China, for America. And again, I'm graphing on the same scale on the left-hand side. The peak up here is 60% of GDP. Hong Kong actually got that high in 1 year. But America's peak level of credit was 15% of GDP when the crisis began, plunged to -5. It's now back about +7. But if you look at the aggregate over that time period, it simply hasn't had the scale of credit demand any more than it had before the crisis. Now, Australia, we're different. Let's see how different we are. Again, we all listen to Malcolm Turnbull, and for that matter Bill Shorten, on the TV. Of course, we know that this little figure down here is really scarily high. Got to do something about it. Let's hold a plebiscite, maybe. But of course, this level of private debt up here, well, you can go surfing on that one. Nothing to worry about there at all. Looking at the correlation of credit to the unemployment rate in Australia, -0.6. The same scale we're talking about for America. Looking at the house price story, of course we've had nothing but a bubble, and of course we know house prices always rise, particularly around Mount Kosciuszko. That's plunged to some extent after the GFC, but it's still substantially positive, again courtesy of government policy dragging people back into the housing market. What about the correlation? Does the same causal relationship apply? Of course it does not. Oh dear, but the correlation is exactly the same as in America. Accelerating mortgage debt drives change in house prices, even in Australia, even with all the government intervention, even with all the foreign buying we're talking about. It's still the same basic causal mechanism. And then take a look at credit now. This is the smoking gun of credit for Australia, and of course it hasn't shot us yet. Notice that the one time it plunged and went negative is back in what we call Keating's crisis, the Keating recession. That's the one time we've had credit growth being negative, or credit being negative. But then we hit the peak in the GFC of 25%, 10% higher than the Americans. But rather than hitting negative down here, it turned around because first of all, what I call the first home vendors boost, dragging first home owners back into taking on debt once more. And then after that started to peter out, which was back in 2010, the business sector was borrowing up big for the mining boom, which the RBA assured them would last 30 years. They're only wrong by, 25? Pretty close for the RBA. Now, what's happening now is we're finally seeing a fall in that level of credit. So I'm breaking it down here. The red line is total credit, which peaked at 24% of GDP at the global financial crisis, went negative for the business sector. And this also happened back in the 1990s recession and at 2002. So business credit is much more volatile than household. But the household credit was positive enough to make the aggregate remain positive. So without the boost from the housing sector through the first home vendors boost, we would have potentially had a recession back then. The thing that stopped us was dragging the household sector back into debt once more. And on this whole front, I've got to take a slash at the bunch of so-called experts up the road. The RBA, I think, if I had to give an award for the most out-of-touch central bank on the planet, it would be them. The Bank of England has woken up quite substantially to the nature of the monetary system, and you get a very intelligent conversation with the Bank of England, and they're amenable to talking to characters like me. I have been once to the RBA. That was on my invitation of me to take a consultant there. I've spoken with RBA staff a few times, of course, but I actually wrote to them in 1996, I think, offering to run a seminar on my Minsky model, and got a letter back, I think, from Glenn Stevens. I've lost the physical letter, declining my offer. Monday of this week, I received 2 invitations to seminars by the Bank of England to present. The Bank of England is far more open-minded and far more realistic about the monetary system than the RBA is. Now, if you look at what they've done, they were the very last central bank to stop raising rates after the global financial crisis hit. So far as they're concerned, they were fighting inflation. Classic instance of generals winning the last war. America, on the other hand, plunged right down to zero and stayed there. When they thought the financial crisis was over, they started raising rates again to fight inflation, which made the mistake of not occurring. So they're cutting rates and they're slowly resisting the pressure, but they're being dragged down by reality back towards the zero level that applies in the rest of the world. And the inflation bogeyman, they thought there was a bit of a rise in inflation immediately after the financial crisis here, but it simply hasn't come back to anything like the levels they thought it would. They're being dragged down by the inflation rate being lower than they always expected it would be. And their forecasts are probably the least accurate of any central bank on the planet, and they've all been inaccurate. What they've really done is give us the highest real interest rates in the OECD since the crisis hit. So the blue line is American real interest rates, which peaked at 4% not long before the crisis hit, but after the crisis went as low as minus 3.5%. Now, Australia's case, they've always been positive except for a short while between 2014 and 2015, and they are the highest real rates of interest on the planet, outside countries like Venezuela. What it actually has done, what they've all really done, is drive up the exchange rate and decimate Australian manufacturing. Because when you had rates that much higher than applied in the rest of the world, then you made a carry trade an absolute no-brainer. You got both the bonus both of appreciating currency by dragging in the dollars, and you got a higher rate of return than you get in the rest of the world as well. Now that the dollar, that they're dropping the interest rate, the currency is also falling. So that particular trade's being killed. But they've killed manufacturing in the process. So here's my swipe at the RBA, but in general what I'm swiping at is not individuals or practitioners, it's a theory. Because the RBA's mistake is to believe mainstream economics. And it's worse than useless at answering the question of why do crises occur, because they assume the economy is always in or tending towards equilibrium. It's a modelling choice made in the 19th century by people like Marshall and Jevons and Volras, who made the sensible conclusion that it's so much more difficult to do dynamic modelling, let's do static modelling and let our successors in the 20th century develop the dynamic tools, which they've never done. They call their models these days dynamic, stochastic, general equilibrium. They're neither dynamic nor general in the true sense of the word. They assume credit can be ignored. Well, I've just shown you that's nonsense. They assume the government necessarily makes the market worse. Now, maybe we should realise that we need a mixed economy. Maybe the market actually is an essential part of a well-functioning economy. Not that we've got well-managed politicians leading us, but the government may play a positive role in the unstable system we live in. And it's encouraged private debt through the Modigliani-Miller hypothesis and all those sorts of ideas that argue the best situation for a firm facing tax payments and when interest can be written off against taxes to have 100% gearing. Okay? They've made us relax about the dangers of private debt when we shouldn't. And the models they use ignore this equilibrium, ignore credit, and assume the government can make things worse. So they get the results that argue for deregulation of everything without any reality in the real world, which is why we're seeing the electorate revolting against them all around the planet. So they were worse than useless before the crisis, and exactly the same thing applies afterwards. If you ask a mainstream economist what caused the crisis, they'll say it's an endogenous shock. Now, before the crisis, they were telling politicians that the current economic situation is better than we've experienced in years. Politicians who swallowed this OECD stuff in June of 2007 were expecting to take the credit in the forthcoming elections for the great state of the economy, because it exploded in their face after that event, which is a major reason why we're seeing a change in some of the central banks, particularly the Bank of England on that front. Now, even after the crisis began, the Federal Reserve's Open Monetary Committee was advised by its own modellers, and the modellers' advice to them in December was that even after all the financial turmoil, the economy avoids recession. Well, that was helpful. Now, 2008, that should be 2008 there rather than 2010. I'm quoting from the date of the book rather than the date of the conversation. But in 2008, there was total panic in the White House. I've actually spoken to Ed Lazaire, who was Bush's chief economic advisor, and he said literally that's the state of mind they were in. They felt that capitalism wasn't going to fail on their watch. They thought if they didn't do something drastic, the whole economy could collapse and they'd be blamed for it, and they weren't going to allow that to happen if they could possibly prevent it. So Paulson, when he was trying to persuade Congress to vote for the TARP program, was asked, what happens if you don't give you the money? And his answer was, may God help us all. That's the level of fear that existed at the time. They threw all their standard macroeconomic principles out the window, threw the kitchen sink at the economy and managed to stop it going down the gurgler. But after the event, the mainstream has attempted to explain the crisis, but all they can say is, well, there were bigger shocks. This is a paper from 2010, where a leading neoclassical economist to Ireland said that the recession was caused by a set of adverse preference and technology shocks. Do you feel any of those shocks go through yourselves? This is all they can generate a crisis for out of their model. Shocks to consumer tastes and shocks to technology. And then he said the crisis occurred because the shocks got bigger and went on for longer. So it's all an exogenous explanation of where the crisis came from. And now, what Larry Summers is blaming for the crisis, I can paraphrase as saying we're having low growth now because parents are having less babies and engineers are having less ideas. Not the fault of the economists. Nothing to do with the financial sector. In writing just in 2014, he said, if a financial crisis represents a kind of power failure, one would expect growth to accelerate after its resolution. So far as Summers is concerned, there's no financial crisis, no financial issues left in the economy. They're all in the past. So you need to explain what's happening now by slower population growth, slower technological change. Now, to drag that argument out of the past, he's dragging it out of Alvin Hansen back in the 1930s, who got it also completely wrong. So can we do better than that? Well, we can. And if you haven't read, I know you know of Minsky, if you hadn't read any Minsky, the book I recommend getting is called Can It Happen Again?, which is a book of short essays, 15, 20-page essays, well written. Do not buy Stabilising an Unstable Economy, okay? Unless you want a good doorstop. Okay? The only book, full book-length treatment you should buy by Minsky is called John Maynard Keynes. It sounds like a biography, it's not. He simply used Keynes's name as a tribute as the title of the book. So the John Maynard Keynes for the extended explanation, Can It Happen Again, for very succinct and well-argued and well-written explanations. Unfortunately, with Stabilising an Unstable Economy, he didn't have anything new to say, really. There was a lot of waffle in that book. Some useful bits, but it's not really worth the effort. But his basic proposition was that capitalism is inherently flawed, being prone to booms, crises and depressions. And this instability is due to characteristics the financial system must have, and they're not an optional extra, to be consistent with full-blown capitalism. And these characteristics will both generate signals that encourage accelerating investment and also enable that to be financed, of course, with debt. And to analyse this, you can't analyse this in an equilibrium sense. It is a non-equilibrium argument. You've also got to you can't ignore money. So I'm going to show you how to model this very, very simply by working from the opposite end to what mainstream economics does. The mainstream thinks you've got to take individuals and scale them up. So their idea of demand is one giant consumer, and their idea of supply is one giant firm. And they extrapolate from the conditions that they believe apply to each of those, where they're totally wrong, of course, extrapolate those to the macroeconomy. That doesn't work for all sorts of technical reasons, which I'm happy to chat about later. What I'm doing is say, let's work from things which are strictly true about the macroeconomy. I'm going to take three definitions. The employment rate is the number of people with a job divided by the population. Does anybody want to disagree with that? It's strictly true. The next one, wages share of GDP is wages divided by GDP. That's also strictly true. And the third one is private debt. The private debt ratio is private debt divided by GDP. So those are three strictly true definitions. Now, to build the beginnings of a dynamic model of the macroeconomy, all you have to do is differentiate those with respect to time. I set that as an exercise for my class of students, which I won't do to you right now. But if you do that, you get these three strictly true dynamic statements about the economy. I've gone from a definition to a dynamic statement. And the first one is employment will rise if the rate of economic growth exceeds the sum of population and growth and labour productivity growth. And that's using lambda for the employment rate. That's the expression here. That's the rate of economic growth. That's technological change. That's population growth. Wages share of output will rise if wage rises exceed labour productivity. That's using omega for wages share of output, and that's wage demands, whatever might be causing them. There's no theory at the moment behind what sets wages, and the rate of technical change. And the debt ratio will rise if debt grows faster than GDP, because that's the main thing I've been focusing upon in my own research. So that's saying that's the rate of growth of debt, that's the rate of growth of real GDP. Now, convert it into a model by taking the simplest possible assumptions you can make, ones that even my own side of economics criticises too simple. And that is, say, let's have a fixed ratio between output and capital, which when you empirically measure, that ratio is between 2 and 4 from most countries. Normally it's 3. A fixed output to employment ratio. So I've got no idea of substitutable factors or anything like that. A linear Phillips curve. I imagine I can use the word Phillips curve here and you know what I'm talking about. And then a linear investment function, which is what I add to say capitalists borrow money depending upon the rate of profit. If they want to invest more than the retained earnings, they have to borrow money. So I've got change in debt, simply financing investment. I don't have any Ponzi behaviour here at all. And then constant technical change and constant population growth. Now, brace yourselves. That gives you this model, which I know looks scary to some people. Not really too bad. And that's the rate of change of employment, rate of change of wages share, and rate of change of debt. What you get out of this model, incredibly simple though it is, are inherent nonlinearities. Because if you notice in the first equation, I've got the employment rate being multiplied by the negative of the wages share and the debt level. In the second equation, you have the wages share being multiplied by the employment rate. And the third equation, you've got the debt level being multiplied by the wages share and itself. Now, those are intrinsic nonlinearities. You can't get that out of the neoclassical mainstream model because they exclude nonlinear terms. They linearise everything. Some of them are starting to try to non-linearise, but even they do that in the wrong way. Now that might still look, that's too pretty simple. You saw how simple the definitions are. Surely you can't learn something meaningful about the economy using that model. I would have thought so too until I first built it back in 1992, because it had an impact which was quite weird. This was not part of Minsky's model. Minsky's theory did not indicate this would be the behaviour, but it gives me two feasible outcomes. One is a slow process of convergence to an equilibrium, where you have a positive employment rate, a positive wages share, and a fixed debt ratio, or what looks like a convergence to that process, and then you start having cycles and a breakdown. So it looks like a great moderation, but it's followed by a crisis. So to show you the first one of those, this is a simulation of where the parameters are set up so you get a convergence to equilibrium. So the employment rate fluctuates but heads towards an equilibrium. Wages share fluctuates and falls, that's important, but heads towards an equilibrium. And the debt ratio rises and hits a constant level, that's a 60% debt to GDP ratio. When you graph it in 3 dimensions, you get a nice, obvious convergence process, like somebody climbing Mount Fuji, getting to the top in circles. On the other hand, when you have the parameters set so that equilibrium is unstable, this is what you see. It looks like you're converging to equilibrium. But then, without warning, the cycles get more extreme. Wages share falls, the cycles fall and then rise. So that's actually a proxy for the inflation rate. And the debt level appears to stabilise but doesn't. You graph that in 3 dimensions and this is the shape you see. Now, if you're only looking at the wages share and employment, which is effectively looking at inflation rate and the employment rate, the stuff that neoclassicals have in their models, project that down onto the x-axis and all you see is convergence. And then suddenly, without warning, you get divergence. You can only understand it by including the debt ratio inside there. When I first showed this to one of my good econometric friends at University of New South Wales when I was doing my PhD, his comment has stuck with me ever since. A guy called Eric Soey, by the way. Anybody do economics at UNSW? If you had Eric, a great guy, Eric said, Steve, if you identified anything that is remotely existing in modern capitalism, we're in deep, deep trouble. That was in 1992, August of 1992. Now, what you see out of this is a whole range of other properties that we have seen happen in the real system. So rising debt causes rising inequality and leads to a crisis. When you solve for the equilibrium values to see what they might be, I get a constant equilibrium value for the employment rate, equilibrium value for the profit share, not for wages share, even though in this model workers are doing no borrowing, they are the ones who pay for the rising debt with a falling income share. So if debt stabilises, then you get a stable share of incomes between the 3 social classes. But if debt continues rising, it's not the capitalists who pay for it initially, it's the workers. So rising inequality, when it happens, is not a sign of something nasty and we really want a nicer society than that. It's a society heading towards an economic crisis. That's why the debt ratio matters. Now, if the debt ratio stabilises, then you don't have rising inequality. If the debt ratio is rising, you have rising inequality, and it is a prelude to an economic crisis. And that's, of course, what we saw happening in the economy. There's also some weird paradoxes too, again, which is realistic. Increasing the propensity to invest should make the economy grow faster, shouldn't it? It doesn't. It leads to a higher debt level and a lower rate of growth. Now, when I won't take you through this is the sort of stuff I bash my students with, but just to show we have to think about the financial sector as an integral part of the macroeconomy to understand what's going on. In this particular simulation, I've got a slope of 5 for the linear investment function that I'm using. That results in a debt ratio of 60% of GDP and a growth rate of 2.8% of GDP, 2.8% per annum. With a higher slope of 6, so capitalists are more willing to invest, you get a debt ratio 2.5 times higher, 150%. As your equilibrium, the growth rate falls 2.5%. So all these issues are things which are left out of mainstream thinking, but are fundamentally obvious with a very simple model of the economy. That's, of course, a simple model. I can make it more complicated. And that scares a few more people. What's actually added there is a interest rate that varies with the rate of inflation, a rate of inflation based on monetary flow and supply and demand to work out what the equilibrium might be, and then having a first order time lag convergence to it. Inflation affects the wages share, and inflation affects the debt ratio. And I've got a lag response by the banking sector to the rate of inflation in terms of setting the interest rates. Now that's pretty obvious gobbledygook, but let's take a look at it in a system dynamics model. This is the software that I've built based on engineering concepts, but added to it the capability of modelling the financial sector. This is the software I call Minsky. So I'll bring that model and I'll run it very slowly so I can talk through the dynamics. I've got the employment rate here, the profit share there, and the inflation rate. Those would be the three I want you to look at. Look also at the debt ratio as the model goes on. And what you get out of this extremely simple model still, there's no complicated logic. It's a structural model of the economy at a very simplified level. You have a period where the cycles in unemployment are falling, a bit like the 50s and 60s. Then they start to rise, like the 70s and 80s. Then they seem to moderate, like the 90s and 2000s. And you think, thankfully, we've finally reached equilibrium, we can all go home. Of course, the mainstream is ignoring this rising level of private debt. They think the low inflation is a good thing. Keep it going a bit further, and that economy, which appeared to be going so well, starts to tank. The employment rate starts to plunge. Capitalists don't actually realise anything is happening yet, because that equilibrium effect, what they've got is got a rising amount they're paying to the banking sector, but a falling amount they're paying to workers, and one is offsetting the other almost perfectly for the last period before the crisis hits. But then the compounding of debt takes off even more because of deflation. Workers' wage demands are as low as they can be, and you continue the simulation. Ultimately, that exponential increase in the debt ratio wipes out the profit rate, and it's good night to capitalism. So that's the danger we have in a financial sector without a government, without offsetting factors in a free market economy. That's the sort of dynamic that Minsky was talking about, and that I think we've experienced, as well as me having modelled just there. So that's these crises as being endemic. You can only prevent them by making capitalists more cautious, and that's not a desirable thing. I'd rather have adventurous capitalists. You can counter it with government spending, but the fetish for government surpluses actually makes this worse. That's why Europe is in such a total funk, because running a government surplus actually destroys money, or takes it out of the real economy and dumps it in the financial sector. And treating the government as being like a household is simply bad economics, even on mainstream thinking, because the government is really like a bank. Banks create money by lending out more than they get back in repayments. The government creates money by spending more than it takes back in taxation. There's no technical reason why the government can't spend. It does not need just tax to spend. So we've got the wrong-headed set of ideas amongst the politicians there, because they've been fed this nonsense by mainstream economists. And they'll fail most of the time to run a surplus. It's simply impossible to do that and have a growing economy. The average deficit in America for the last 120 years is 3% of GDP. You leave out the Second World War, it's 2.8% of GDP. Now, that's the positive side of looking at government. I can put a negative proposition forward as well. It appears that big government encourages excessive private debt, because if you look at the pre-depression economy, where the government spending was about 5% of GDP, then the debt level never exceeded 80% of GDP, the private debt level. Post the Depression, government spending has been 30% of GDP, and I think that softened the resistance of the private sector to going into debt. We've had much higher private debt levels after the Great Depression than we've ever had before. So if you look at the 19th century and the 20th century, the red line is a normalised data plot of the private debt to GDP ratio. The blue line is credit. You can see there were credit crises pretty much every 10 to 15 years throughout the 1900s, the 1800s. But the debt ratio only once reached 80% of GDP before the Great Depression hit. We hit 80% of GDP as a debt level in 1963. So we've had an extended period of high debt, and you look at the credit impact only around the camping stage of the Second World War was there negative credit. Throughout the entire period, we've had positive credit. This is American data. It's more extreme for Australian data. So I think the government actually encourages, to some extent, more private sector debt. And I think the only way to counter this is to actually use government's money creation capacity to reduce private debt, to stop it getting to those levels. And I call this a modern debt jubilee. I'd actually use the government's money creation capacity to do what they call people's QE, with the double condition that debtors must reduce their debt, whereas savers get a cash injection. That would reduce the debt level and get us back to the stage where credit growth can occur once more without making it unprofitable for banks to lend money. You don't want to stop the bank sector lending. I also want to control lending for things like property. I'd like to have a limit of the amount of lending that can be done by a bank, not on the income of the borrowers, which is always fudged, as we know, but on the income earning capacity of the property they're fighting over. Instead of setting like 10 times the annual rental income as the maximum anybody can borrow. And that would stop leverage driving up house prices. It would mean the person who'd buy the house is the person who saved more money. But I also want to make it profitable for the banking sector to lend to entrepreneurs, because a major problem in capitalism is we're not funding entrepreneurial activity, and there's a damn good reason not to. If you lend to 6 entrepreneurs, 5 are going to fold. You get interest earnings on one of them, you lose money. Okay? So that's a good reason not to lend to entrepreneurs. What if we combine venture capital with banking at what I'm calling entrepreneurial equity loans, or EELs, where you took an equity stake in the business you funded, and if 5 out of the 6 fold and one becomes a roaring success, you make a capital gain out of the one that does. You'll lose your money on the other 5, but you can make a gain out of the other one. So something that blends the two together, I think, is needed to get away from continuous crises. Otherwise we face just a period of continuous stagnation. What we're doing right now, the policies supposedly trying to direct this crisis, are either irrelevant or making things worse. People call QE money printing. It is not money printing. It's money printing in the same sense that putting lubrication oil into your car is filling up the petrol tank. It's not going into the same place. It's putting money into the reserve accounts of banks at the central bank. It's not putting money into the public's account at private banks. So it's not going to work. All it's done is inflate asset prices. A whole lot of bad logic there about it. Banks lending from reserves, which is just nonsense as well. It's levered up asset prices. It made them increase them even more after the crisis. And I'm finding a lot of family offices I speak to, the managers are suffering from serious stress, having to manage the economy based on what they think Janet Yellen's going to do next week, rather than what they think is going to happen in the market. Nobody is enjoying this. Negative rates for banks, that's another nonsense idea, because the Swiss central bank is charging minus 0.75 on reserve deposits of the central bank, in the naive belief that will encourage banks to lend from reserves, which they can't do. In the equally naive belief that private banks will pass those negative rates on to their depositors. Any private bank that did that would lose its customers, so they don't do it. What they can't lose, of course, is their debt customers. So what they've done in response is increase mortgage rates. Okay? It's the exact opposite of what they're trying to cause. They're actually reducing demand by causing negative rates. So the central banks do not know what they're doing, except the Bank of England to some extent. So I see us facing a crisis and very soon, in the next 1.5, 2 years. I simply can't see us continuing. To avoid this crisis, we have a household debt ratio now of 125% of GDP. It would need to hit 150% by 2020 for us not to have a recession before then. I simply can't see that happening. We're already world record holders. We're not going to do a lot more than that. Now, of course, once this hits, the government will go from obsessing about a surplus to throwing it out the window. You know the old Groucho Marx, the Groucho Marx quote about I wouldn't be a member of any club that would have me as a member. Well, another one of his classics was to say, these are my principles. If you don't like them, I have others. That's Malcolm, isn't it? Well, even more so, I think, once a crisis hits. The surplus pledge will go out the window. Deficit spending will come in. Apparently it's already happening with some of the public sector capex spending right now. But that will attenuate the downturn. We certainly can't rely upon exports anymore. The rest of the world is already in the state we're about to reach, so we can't get much export demand out of the rest of the world. China certainly isn't going to do anything for us. Chinese property buying might attenuate the crash because that does bring cash into the economy, that does stimulate the economy. But equally, we've got a very Stalinist leadership of the Communist Party in China these days. I wouldn't want to bet which way they're going to move. Will they try to squeeze on people who've taken money out of the country and force repatriations back in a way that the Chinese seriously can do? Or will they stuff up, or will they try to let their own party members get the money out of the country anyway? And it's a huge gamble to rely upon the Chinese sector to keep you going. And We're not going to be alone. That's one of the fortunate things. Misery loves company. China, Canada, Korea, Sweden and Norway are some of the other countries that are going to face a credit crunch. I want to take you through some of the statistics there, and then I'll take a break and have a conversation. These are the countries that have a debt ratio above 190% of GDP. And what I've done in this table is to look at what's going to be the impact of the debt level continuing to grow as it has, stabilising, or the actual level of debt stabilising. So looking at Portugal, for example, its GDP last year was 195 billion. Last year its debt level was 377 billion, giving it a ratio of 193% of GDP. If its current growth rate continues, it'll fall because debt's actually falling in Portugal. So that gives you, I'm trying to get my mouse to activate here, that will give you a lower debt ratio next year. Now, that last year, the growth in demand in the Portuguese economy was 6.7%. If the ratio stabilises, it'll actually be higher at 16%. If the level stabilises, it'll still be higher at 9% because the debt level's falling. Looking at Australia, our GDP last year was $1.19 trillion US. Debt level, $2.46 trillion, ratio of 210% roughly. If the rate of growth continues, it'll be 217% roughly at the end of the year. Last year, in fact, the demand fell by 2%. When you add GDP to credit, of course I know there's some double counting going on there, you get a negative over the previous year. If the ratio stabilises at 208%, there'll be a 5% fall in total expenditure. If the level of debt stabilises, there'll be an 8% fall. So simply stabilising the debt ratio will cause a downturn. Those are the countries that I think are most fragile to this, but there are others. So I'll just take you through a couple of charts. So this is the overall, using the whole BIS database and applying the same analysis there. And I'll copy this to Teague. He can pass it around to you guys later. You can therefore read it. So those are the countries I see as vulnerable. China, Korea, Australia, Switzerland, Sweden, Belgium, Norway, Hong Kong. Hong Kong, I've got a question mark about having just looked at the data more carefully for Barclays recently. Finland and Chile. So the high debt ratios and a high impact of a debt slowdown are what identify those countries. Malaysia is also possible, but it does have a lower level of debt. And the countries which are already zombified, already got so much that they can't get growing demand, the USA, the Euro region in general, Japan, of course, and the United Kingdom, they have high debt ratios and low credit since 2008, and they're not going to get high credit until we reduce the level of private debt, which of course we're nowhere near doing as yet. So to show those countries in Asia and rank them, Hong Kong has the highest level of debt, but I've got a feeling it's mainly corporate debt, and I've got a feeling a lot of that is booked to Hong Kong, but not actually borne by Hong Kong. You can get the distinction. China, number 2, Australia, number 3, and Korea, number 4. Singapore, Malaysia and Thailand are sort of in the relatively tricky but safe zone. Indonesia stand out with an incredibly low level of debt. Of course, after their horrific crisis in 1997, they haven't gone near debt anything like the scale of the rest of the global economy. So I see them as actually probably the safest currency coming up. When you look at credit growth, the change in debt, then you find China's by far the top. Australia, not far, about half the level of Chinese credit. Korea, Hong Kong, Malaysia, and again Indonesia right down the bottom. Very little reliance upon credit in Indonesia, huge reliance upon credit in China and Australia. Now China's got the biggest bubble of all, of course. And when you look at it, it was a policy response by the government to the financial crisis. There was a huge exodus of workers from the seaside cities back into the countryside when the crisis hit because of about a 40% fall in Chinese exports when the crisis began. And that drove the unemployment rate in China from 4.09% to 4.09%, if you trust the official stats. Okay? Of course, dramatic increase in unemployment, political instability. The government response was to tell the banks, half of which are state-owned and the other half no to obey the state, to lend to anybody with a pulse. And so you had a debt ratio rising from being pretty much flatlining at 1.2 times GDP up to 1.5 and now finally 2.1 times GDP. Now, the form the crisis will take in China is going to be quite different to anywhere else, but it can't avoid a crisis, and I think the data is showing it's going through one right now. Though whether you can trust, the data itself, of course, is very problematic with China. So looking at the level of credit before and after the crisis, this is the smoking gun of credit for China. Before the crisis, the average, in the decade before the crisis, credit was averaging 15% of GDP. After, it's been 27%, far in excess of the rate of growth of nominal GDP. They simply can't sustain that level of growth. So it'll face a debt crisis, but the form that it takes, very, very hard to work out. They're running at the moment, as I said, about a 29% credit level of GDP. Huge. They can't sustain it. Whether they will see it in the data itself, I don't know. How they'll hide it, another question, but they are going to have a crisis. Malaysia doesn't have the same debt level, but it is dependent upon credit to about the same level as Australia right now, and it's trending down. So Malaysia, I'd see, is somewhat vulnerable, but not as bad as we are by any means. Singapore is having a credit slowdown right now, quite substantial, but it doesn't have the same debt ratios we're talking about. Indonesia had an off-the-scale crisis, quite literally on my graph, but now credit, as you can see, is a fairly trivial contributor to demand. So they're not going to suffer a crisis. Other countries will, they won't. Not from credit. Hong Kong looks like a gigantic slowdown is hitting them right now. So it was a peak of 45% of GDP was the credit levels just a couple of years ago. Now it's 15%. But that largely relates to changes in the corporate sector. Because when you look at corporate debt, it exploded from 1.4 times GDP, which itself was huge, to 2.3 times GDP and is now trending down. Household debt is substantially lower than Australia. So even though there's clearly a housing bubble in Hong Kong, I can't blame it on mortgage borrowing to the same extent as it applies in Australia. So that corporate debt might reflect debt that's on the corporation's books there, but is actually being financed by elsewhere in global corporations. So that's pretty much it. Let's have a chat. Thank you.